Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Carpenter Technology CORP quarterly report. Carpenter Technology Corporation offers a diverse range of businesses and services, including specialty alloys production, titanium, stainless steel, alloy steel, tool steel, metal powders, and parts fabrication, distribution of specialty metals across various regions, services to multiple industries, plus aerospace, plus defense, plus medical, plus transportation, plus energy, plus industrial, plus consumer. Carpenter Technology Corporation, CRS, has seen its stock price skyrocket in the past year due to a combination of strong financial performance, robust demand in key markets, and positive analyst sentiment. The company has consistently surpassed market expectations with exceptional earnings performance, driven by record margins, and a 31% increase in earnings growth for Cone F26. Strong demand in aerospace and defense sectors, where Carpenter Technology supplies specialty metals, has also been a significant driver of its success. Analysts have responded positively, setting average 12-month price targets suggesting further upside potential. The company's robust financial health, steady revenue growth over the past 3 years, and consistent dividend declarations have further contributed to investor confidence. The stock reached an all-time high in October 2025, reflecting strong investor confidence and stable leadership continuity, with Tony R. Thien taking on the role of chairman of the board. Overall, these collective positive developments have fueled investor confidence and significantly contributed to Carpenter Technology Corp's stock price appreciation over the past year, resulting in a possible increase exceeding 95% over a slightly longer period. The primary drivers of revenue growth or decline can be summarized as follows. Revenue growth is primarily driven by the aerospace and defense end-use market, plus 8% to plus 11%, energy end-use market, plus 4% to plus 8%, and specialty alloys operations segment, plus 2%. Additionally, intersegment sales have seen a significant increase of 31%. These factors contribute to overall revenue growth. On the other hand, revenue decline is primarily driven by the medical end-use market, minus 14% to minus 16%, transportation end-use market, minus 19% to minus 15%, and distribution end-use market, minus 16%. The performance engineered products segment has also seen a decline of 7%. These factors contribute to overall revenue decline. The surcharge mechanism, which recovers increases in raw material costs, has a neutral effect on revenue. Net income and profit margins experienced significant growth between 2024 and 2025. Net income increased by 44% from $84.8 million in 2024 to $122.5 million in 2025, driven by a combination of factors including improved product mix, pricing actions, and operational efficiencies. Profit margins also saw substantial improvement, with the operating profit margin rising from 15.8% to 20.9%. The adjusted operating margin excluding surcharge revenue increased even more dramatically, jumping from 20.3% to 25.4%. This growth was particularly pronounced in the specialty alloys operations (SAO) segment, which reported an operating margin of 25.9% in 2025. The primary drivers behind these changes were a shift towards more complex and higher-value materials, as well as pricing actions and expanding operational efficiencies. These factors collectively contributed to the significant increase in net income and profit margins, positioning the company for continued growth and success. The company is generating a significant amount of positive operating cash flow, with net cash provided from operating activities reaching $39.2 million in both 2025 and 2024. This indicates that the company's operations are producing sufficient cash to cover its expenses, resulting in a positive cash flow. The consistent generation of positive operating cash flow suggests that the company is financially stable and able to meet its obligations. The company's financial summary reveals a stable long-term debt level over the past year, with a slight increase of $0.3 million. However, there has been a notable decrease in interest expenses, with a 7% reduction from 2024 to 2025. Specifically, accrued interest expense decreased by $12.1 million, and net interest expense dropped by $0.9 million. These changes indicate that the company's financial obligations have become less burdensome over time. The company's financial performance varied across different segments and regions. The Specialty Alloys Operations (SAO) segment showed improvement, with a 2% increase in net sales despite a decline in pounds sold by 11%. In contrast, the Performance Engineered Products (PEP) segment struggled, experiencing a 7% decrease in net sales along with a 13% drop in pounds sold. The intersegment also performed well, with significant increases in both pounds sold and net sales. Regions such as Reading, Pennsylvania, Latrobe, Pennsylvania, South Carolina, and Alabama within the SAO segment contributed to its success, while Mexico's performance was part of PEP's decline. Management is optimistic about the company's outlook, expecting future increases in operating income driven by growing sales and expanding margins. They plan to achieve this through high-value growth initiatives such as brownfield capacity expansion. The company will take a balanced approach to capital allocation, investing in growth while also returning cash to shareholders. Management expects strong multi-year growth in key markets like aerospace and defense and energy. The company has demonstrated a commitment to returning value to its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $10.1 million in 2025 and 2024, with a consistent frequency of $0.20 per share. Additionally, the company has also engaged in share buybacks, repurchasing 200,000 shares in 2025 and 230,000 shares in 2024 for a total amount of $49.1 million and $32.1 million respectively. Concerns about inventory buildup and supply chain disruption exist. The company faces significant concerns regarding inventory buildup and supply chain disruption. On page 11, it is explicitly stated that inventory buildup is a concern. The volatility of raw material costs has also impacted operations, page 26, with commodity forward contracts used to mitigate the risk. In specific end-use markets, there are potential issues. Lower shipments in the medical market due to managing inventory levels closely, weaker consumer demand for light-duty vehicles in the transportation market, potentially leading to inventory buildup, and decreased rig counts and shipments in the energy market, supply chain disruption. Furthermore, cash flow from inventory was $15.6 million in Q3 2025, but this is a decrease from the $16.8 million used to build inventory in Q3 2024. Additionally, there are concerns about suppliers meeting their obligations due to supply chain disruptions and difficulties obtaining energy or raw materials, page 41. These issues highlight the need for careful management of inventory levels and supply chains to mitigate potential risks. That concludes the financial summary for Carpenter Technology CORP. Feel free to comment below, and I will be happy to answer them when possible.